Mrs. Voss, the Meridian account, we need you to walk us through what the real reports would show.
Yes, I can show you. Everything is in the underlying files. I can pull every transaction.
Marlena Voss ran Cedar Hollow Women's Refuge for over a decade. And for 4 of those years, no one checked the bank statements she handed them. One new volunteer finally did. That question ends her career today.
The real records, not your summaries.
The forensic accountants had spent 9 weeks reconstructing what she just spent 90 seconds denying. 4 years, roughly $520,000. A shell vendor that existed nowhere on Earth except in the ledger of a shelter for women fleeing violence. Every padded invoice was a bed that never got funded. Every skimmed grant was a relocation that stalled. She was executive director of Cedar Hollow Women's Refuge for 9 years, and by the end of this hour, the board would learn the exact address the money never reached. Real talk. How do you steal from women who already lost everything and sleep at night for 4 years straight? Drop that answer in the comments if you have one, because I still don't. And if you're new here, subscribe. We cover the cases that hide behind good intentions, because those are the ones nobody else touches. Marlena Ray Voss was born in 1975 in a mid-sized Midwestern town, the middle of 3 daughters in a family that would later become the reference point for every biographical profile written about her. Her father was a regional insurance adjuster. Her mother taught 5th grade for 29 years at the same elementary school on the same tree-lined street. The family was not wealthy, but they were the family other families borrowed from. A station wagon in the driveway. Casseroles delivered to sick neighbors. A mother who kept the class list of every student who had ever passed through her room and remembered every one of them by name. Marlena inherited that impulse young. Her high school yearbook listed her as vice president of a student volunteer organization, a Girl Scout for 11 years, and a peer counselor for freshmen who were struggling to adjust. Teachers described her as unusually attuned to other people's difficulties. She was, in the words of one former guidance counselor, the student the office sent the crying kids to when the adults did not know what to do. She enrolled at a small state university in 1993 and majored in sociology with a minor in nonprofit administration, an unusual combination for the time. She waited tables at a diner off the interstate to cover what her parents could not. Her professors remembered her as diligent and quiet, the kind of student who read the assigned material and the recommended material both, and turned in papers 3 days early. She graduated in 1997 with honors and a stack of unpaid internship offers from social service agencies across 3 states. She took the one that paid the least, an intake position at a rural crisis center for domestic violence survivors, $13 an hour, no benefits, 1 desk in a converted living room of a donated Victorian house on the edge of a small county seat. She stayed for 4 years. She interviewed hundreds of women in that living room. She learned the specific vocabulary of the work: safety planning, protective orders, custody bridging, the difference between a hotline call and a walk-in. She learned that most abusers never spent a night in jail and that most survivors returned home at least once before leaving for good. She learned that the paperwork mattered, because the paperwork was the only thing standing between a woman and the system that had already failed her. In 2003, she was hired as a caseworker at Cedar Hollow Women's Refuge, a mid-sized shelter founded 3 years earlier by a coalition of clergy, county social workers, and 2 retired judges. Cedar Hollow served a metropolitan county of roughly 400,000 residents and averaged 180 intakes per year in her early days there. The building was a repurposed 2-story brick nursing home on a quiet residential street, its address unlisted for safety reasons, its windows fitted with reinforced glass, and its small parking lot monitored by 3 cameras that no one ever thought to point inward. She was good at the work. She was good at the work in a way that made her supervisors nervous, because she stayed late, took calls at home, learned every client's children's names, and refused to leave the building on nights when a new intake was still processing. In her first performance review at Cedar Hollow, her supervisor wrote that she was profoundly committed and occasionally too involved in individual cases to maintain a healthy distance from the work. Marlena filed the review, initialed the note, and did not change her behavior. She was promoted to program manager in 2008 after the previous program manager retired. The role gave her oversight of the case management team, the residential coordinators, and the 2 staff members who managed community outreach. Her salary rose from $38,000 to $52,000. She took on additional responsibility for grant reporting, a duty her predecessor had disliked and had performed inconsistently. Marlena performed it meticulously. Her reports were the cleanest the county had ever received from Cedar Hollow. They were, one county grants officer would later say, the reason the shelter kept winning renewals when other agencies were losing them. In 2014, the founding executive director, a woman in her late 60s who had run the shelter since its inception, announced her retirement. The board conducted a national search. They interviewed 12 candidates. They hired Marlena. She was 40 years old. She had spent 11 years in the building. She knew every closet, every client file, every donor's name, every grant deadline, and every county social worker on the shelter's referral list. The board chair told local reporters at the announcement that Marlena Voss was not just the right person for the job. She was, he said, the person the job had been waiting for. She took the office at the end of the second-floor hallway, the office that had belonged to the founder, and she did not change the furniture for the next 9 years. Cedar Hollow Women's Refuge operated on an annual budget of approximately $1.4 million during Marlena's tenure as executive director. Roughly 40% came from county and state grants, 20% from federal pass-through funds tied to survivor services, the remaining 40% from private donations, a spring gala, and 2 small endowments held by local community foundations. The shelter maintained 22 beds across 3 residential floors, a 24-hour crisis line staffed by trained volunteers, and a small legal advocacy program run by 1 part-time attorney and a rotation of pro bono law students. The financial structure was typical of small and mid-sized nonprofits in the sector, which is to say, it was structurally vulnerable. Marlena was the primary signatory on the operating account. She controlled the corporate credit card. She approved payroll. She reconciled the books each month. She prepared the financial summaries presented to the board at their quarterly meetings. She was the only person at Cedar Hollow with a full picture of the money, where it came from, where it went, and what remained. The board had 9 seats, filled by volunteers with day jobs, a pediatric dentist, a retired school teacher, a commercial real estate broker, 2 clergy members, a local business owner, 2 attorneys who did occasional pro bono work for the shelter, and, for most of Marlena's tenure, a rotating treasurer's seat that had been held by 5 different people in 9 years. A rotation caused by relocations, health issues, 1 resignation over a disagreement about fundraising strategy, and, in one case, a treasurer who simply moved out of state. None of them were accountants. None of them audited line by line. They reviewed Marlena's summaries. They asked polite clarifying questions. They approved the minutes and moved to the next agenda item. They trusted her because she had earned that trust across 11 years of exemplary work before the promotion, and 8 more years of what looked like exemplary work after it. Trust that specific is hard to overstate. The board did not audit her because, in their minds, she was the shelter. Auditing her would have felt, to some of them, like auditing themselves. The annual independent audit was performed by a small local firm that had audited Cedar Hollow since its founding. The audit was not, technically, a fraud audit. It was a financial statement audit, a review of whether the numbers Marlena presented reconciled with each other, whether standard controls appeared to be in place, whether the general ledger balanced. It was not designed to detect a determined insider with signatory authority. That distinction, the forensic accountants would later explain to the board in the aftermath, is the vulnerability that virtually every nonprofit embezzlement case in the country exploits. The grants came with restrictions. A state emergency housing voucher program, for instance, required that funds be spent only on documented client relocations, with itemized receipts and a monthly reporting cycle. A federal survivor services grant required quarterly reports detailing hours of counseling delivered, meals served, beds occupied. Each restricted funding stream was, in theory, a separate ledger, walled off from the operating account, tracked line by line, verified against outcomes. In practice, at Cedar Hollow, all of those ledgers ran through Marlena. She was, in her own words, delivered years later in a written statement to the board, the choke point through which everything the shelter did had to pass. She had described this in her original interview as a strength. She had described it in staff meetings as a vulnerability the shelter needed to address, someday, when there was time. And then, for 4 straight years, she exploited it. The first fraudulent invoice was dated March 14, 2019. It was for $2,460 and change, made payable to a vendor called Meridian Facilities Services, for what the invoice described as quarterly perimeter security assessment and lighting maintenance. Cedar Hollow had never contracted with Meridian Facilities Services. Meridian Facilities Services did not exist. Marlena had created the vendor 2 weeks earlier. She registered a mailbox at a private mail rental storefront in a strip mall 20 miles from the shelter, opened a small business checking account at a regional bank using a fabricated employer identification number generated in a format designed to not immediately fail a routine software check, and printed invoice templates on her home computer using a design she had adapted from a real security vendor's public website. The name was chosen for its plausibility. Meridian sounded institutional. Facilities Services sounded boring. Both were true. The first check cleared in 6 business days. Nothing happened. No one asked. The board reviewed the operating expenditures at the next quarterly meeting and approved the summary without discussion. She ran the second Meridian invoice in June, $3,112 for emergency lock replacement and access control review. She ran the third in August, $4,800 for annual security consultation and site risk audit. By the end of 2019, she had routed just under $20,000 through the shell vendor. The board minutes for that year contained no reference to Meridian Facilities Services by name, only line items labeled facility security and contracted maintenance. The second scheme was slower and more careful. She began quietly inflating invoices from real vendors. The shelter used a real commercial cleaning company, a real plumbing contractor, a real HVAC firm. Marlena had signatory authority to approve those invoices. She began adding line items to legitimate bills. A service call that hadn't happened, a supply charge that had never been ordered, a labor hour that no technician had worked. She would pay the full inflated amount to the real vendor and, separately, arrange for the difference to be reimbursed to her personally through a series of small transactions designed to look like refunds and rebates. The third scheme was the corporate credit card. Cedar Hollow's card was in Marlena's name, held for organizational expenses. She used it for a Caribbean cruise in the fall of 2020 that she coded as Conference Travel Survivor Advocacy Summit. She used it to fund the down payment on a leased SUV that she coded as a facility vehicle, and then coded the monthly lease payments as fleet expenses. She used it for a series of renovations at her home, a new kitchen in 2021, a primary bathroom in 2022, a landscaped back patio in the summer of 2022 that included a stone fire pit and outdoor lighting. She coded every one of those charges as facility upkeep on the shelter's second-floor staff apartment, an apartment that in fact received a single coat of paint during that 4-year period, applied by a volunteer, at no cost to the shelter. The fourth scheme was the one that would, in the eventual sentencing memorandum, be described as the most morally grave. Cedar Hollow received restricted funds from a state emergency housing voucher program specifically designated to relocate women who could not safely return to their previous addresses. The vouchers averaged $700 to $1,200 per client, depending on family size and duration. Marlena skimmed portions of that grant across all 4 years of the scheme. When the state required quarterly reporting on voucher expenditures, she falsified the reports. She invented client codes. She fabricated expenditure dates. And in at least one instance investigators later documented, she used the real intake number of a former client whose case had closed 18 months earlier. Each of those falsified vouchers represented a woman who did not receive relocation funding. The shelter did not formally deny the vouchers. The women were told the funds were coming, then told there was a paperwork delay, then told to try the county program, which had its own waiting list. Then, in some cases, told nothing at all. She reconciled everything herself. When the numbers didn't work, she altered the reconciliation summaries. She did this by hand, on printed pages, using a different pen than the one she used for board memos, and she filed the originals in a locked drawer in her office. She kept 2 sets of books. The set she showed the board reconciled cleanly every month. The set she kept for herself, in a spiral-bound accountant's ledger stored behind 3 legal reference volumes on the top shelf of her office bookcase, showed the truth. She would later tell the forensic accountants that she had believed, at first, that she would return the money. That the shelter was going through a rough patch and she would replace the funds when things stabilized. That belief, she said, lasted about 6 months into year 1. After that, she simply kept going. In the spring of 2023, the board treasurer's seat rotated again. The outgoing treasurer, the commercial real estate broker, had served 2 years and rotated off per the bylaws. The incoming treasurer was a woman named Ruth Ellery, a recently retired certified public accountant who had spent 31 years at a regional accounting firm before retiring at 68. She had raised her family in the county, donated to Cedar Hollow annually for a decade, and had recently attended a fundraising event at which she had introduced herself to Marlena and mentioned, casually, that she was looking for a nonprofit board seat that would let her use her professional skills in retirement. Marlena, at the time, had congratulated her on the appointment. Ruth Ellery attended her first board meeting in April. She was given a binder containing the previous 4 quarterly financial summaries, the audit reports from the past 3 years, and a 2-page overview of the shelter's funding sources. She read every page of it that night at her kitchen table. She flagged 4 questions in the margins in fine-tipped pencil. Her first question, submitted by email to Marlena 3 days after the meeting, was simple. She wrote, "I'd like to review the underlying bank statements alongside the operating summary for the past 12 months, just to familiarize myself with the account structure. Could you have the bank send them to me directly, or shall I request them?" Marlena replied within 2 hours. She wrote that she was happy to compile the statements herself and would have them ready within the week. She wrote that Ruth was welcome to come by the office anytime and review them in person. Ruth wrote back thanking her and adding, in what would later be described by the outside attorney as the most consequential sentence in the case, "Actually, if it's all the same to you, I'll just have the bank send them directly to me. I'd like to see them cold." Marlena did not reply for 2 days. When she did reply, she wrote that, of course, that was fine, and that she would authorize the bank to release copies to Ruth as a fiduciary. She did authorize the release. She had no choice. The bank sent Ruth 12 months of statements as PDFs in a single email on a Tuesday morning. Ruth Ellery spent the following weekend at her kitchen table with 2 documents laid side by side. On her left, the 12 monthly financial summaries Marlena had presented to the board across the previous year. On her right, the actual bank statements the bank had just sent her. The 2 documents did not match, not in small ways, not in ways that could be explained by timing differences or accrual accounting conventions. They did not match in ways that added up to hundreds of thousands of dollars across a single fiscal year. She saw the payments to Meridian Facilities Services first, because she noticed a vendor name she had never encountered in the shelter's summaries. There were 16 payments to Meridian across the 12 months, totaling roughly $41,000, and Meridian appeared in the bank record and nowhere in the summaries. She underlined the name in pencil. Then she opened her laptop, ran a business registration search in the state, ran a corporate lookup in 3 neighboring states, and typed the vendor's name into a search engine. She got nothing. No website, no filings, no business record of any kind. The address on the invoices, when she looked it up, traced to a private mailbox rental in a strip mall. On Monday morning, she called the board chair. She did not tell Marlena. The board chair, a pediatric dentist named Marcus Halloran, took the call in his office between patients. Ruth walked him through what she had found. She did not use dramatic language. She said the numbers didn't reconcile. She said the discrepancies were in 6 figures. She said there was a vendor in the bank record that did not exist in the shelter's summaries and did not appear to exist anywhere in the state at all. She said the board needed a forensic accountant. She said they needed to bring in outside counsel. She said Marlena could not be told until both were in place. Marcus canceled his afternoon appointments. The board convened an emergency executive session over video that Thursday evening. Ruth presented her findings. The board voted unanimously to retain a forensic accounting firm and a local attorney who specialized in nonprofit governance. They voted unanimously to leave Marlena in her position for the moment, to preserve normal operations and to avoid tipping her off while the review took place. They voted unanimously that no staff member below the executive director and no one else at the shelter would be informed. The vote was 8-0, with 1 abstention from a board member on vacation who joined the call from a hotel lobby. The forensic accountant, a partner at a mid-sized regional firm with a specialty in fraud examinations, arrived at the shelter under the cover story of a routine internal controls review commissioned by the board. She spent 9 weeks in the building. She worked out of a small conference room on the first floor, ate lunch with the staff, and asked Marlena questions in a friendly, methodical way that Marlena, in retrospect, had found slightly unusual, but not alarming. She was, Marlena would later admit, disarmed by how ordinary the woman seemed. The forensic accountant reconstructed 4 years of transactions. She traced every payment to Meridian Facilities Services, to the mailbox rental at the strip mall, then to the small business checking account, then to a series of small transfers into Marlena's personal accounts. She subpoenaed the small business checking account and matched the deposits to the withdrawals. She cross-referenced the inflated invoices against the real vendor's internal records. One of the vendors, a family-run HVAC company, was startled to learn that Cedar Hollow had been paying 20 to 30% above their actual billing for years and cooperated immediately. She matched the credit card charges to receipts, to travel records, to the county assessor's records on Marlena's home renovations. She reconstructed the falsified grant reports against the actual voucher expenditures. She built a spreadsheet with more than 2,000 line items. The most damning evidence was not any single document, it was the pairing of them. On one side of the conference table, the forensic accountant assembled the monthly financial summaries Marlena had presented to the board across 4 years. 48 documents, each initialed in Marlena's handwriting at the bottom right corner in the same blue pen. On the other side of the table, she laid out the actual bank statements for the same 48 months, obtained directly from the bank on the bank's own letterhead. Same account, same months, different numbers. Marlena's handwriting on one set, the bank's own printout on the other, and a shell vendor named Meridian Facilities Services appearing on exactly one of the two. The forensic accountant delivered her preliminary report to the board on a Tuesday in late June. The total, she said, was approximately $520,000 diverted across roughly 4 years. She said in her professional opinion, the pattern was consistent with a determined insider who had exploited signatory authority and reconciliation control, and that the falsification of the grant reports elevated the case above ordinary embezzlement into what she described in her written report as, quote, theft from women who had been promised specific help. The board scheduled a meeting for the following Friday morning. Marlena was told it was to discuss the coming year's fundraising strategy and the direction of the fall gala. She spent Wednesday and Thursday preparing a presentation. Before we walk into that boardroom, if you've stayed with this case, you already understand why it hits differently than a straightforward embezzlement. Subscribe if you want to see the moment the trust actually broke. We cover these cases the way they deserve to be covered, and the confrontation coming up is one of the quietest we've ever documented. Not one raised voice in the room. She arrived at the shelter that Friday morning at 7:45, her usual time, and unlocked the front door with her usual keys. She stopped in the kitchen for coffee, said good morning to the residential coordinator on the overnight shift, and walked to her office. She reviewed her email, opened the board meeting binder she had prepared herself, and walked down the hall to the conference room at 9 o'clock exactly. The board was already seated when she arrived. Marcus Halloran, the chair, Ruth Ellery, the treasurer, 4 other members, and 2 people she did not recognize, the outside attorney and the forensic accountant. On the conference table, laid out in 2 long parallel columns, 48 monthly financial summaries on one side, 48 bank statements on the other, running the entire length of the mahogany. Marlena stopped in the doorway. She did not step in. Marcus asked her to sit down. Marcus said, "Marlena, the board has retained outside counsel and a forensic accountant. We've been conducting a review of the shelter's finances for the past 9 weeks. We'd like to give you the opportunity to look at what we've found." Marlena did not sit down for a long moment. She looked at the 2 columns of paper. She looked at Ruth Ellery. She looked at Marcus. She sat down. Marcus slid a single sheet across the table. It was a summary, a 1-page comparison of the 2 ledgers, month by month, 4 years of divergence, ending in a total. Marcus said, "Can you help us understand this?" Marlena picked up the paper. She read it. She set it down. Marlena said, "I don't have an explanation right now." Marcus said, "Marlena, this is a payment to a vendor called Meridian Facilities Services. Do you know who Meridian Facilities Services is?" Marlena said, "I would have to look at the records." Marcus said, "Marlena, there are no records of Meridian Facilities Services. Anywhere. The company doesn't exist. We've checked." She did not answer. Marcus said, "Marlena, did you create that vendor?" She looked at the table for what one board member later described as the longest silence any of them had ever sat through in a professional setting. It lasted, by the outside attorney's recollection, close to 40 seconds. In that time, no one else in the room spoke. No one moved. The clock on the conference room wall ticked audibly. Marlena said, "I would like to speak to an attorney." Marcus nodded. He said the board was placing her on immediate administrative leave. He asked her to surrender her keys, her corporate credit card, and her building access badge, right there at that table. He asked her to leave her laptop and her personal effects for now. The outside attorney, he said, would arrange retrieval later. She unclipped the badge from her lanyard, set it on the table next to the bank statements, laid her keys and the corporate card beside it, and walked out of the shelter she had run for 9 years without saying another word. The board contacted law enforcement that afternoon. The forensic accountant's report, running to just over 300 pages with exhibits, was delivered to prosecutors the following week. Investigators executed a search warrant at Marlena's home on a Tuesday morning, seized the spiral-bound accountant's ledger from behind the legal reference volumes on the top shelf of her home office bookcase, seized her laptop, seized 4 boxes of financial records, and interviewed her briefly on the front porch. She answered no questions and referred them to her attorney. She was charged, on a schedule set by the county prosecutor's office, with theft and embezzlement of institutional funds, multiple counts of fraud in connection with the shell vendor scheme, and falsification of financial records related to the altered reconciliation summaries and the fabricated grant reports. The indictment ran to 29 counts. Her attorney negotiated for several months. The evidence, he told her privately, was documentary and overwhelming. The 2 ledgers alone, in her own handwriting, made a trial functionally unwinnable. The grant fraud counts carried the highest exposure because they involved restricted federal and state funding streams and a documented pattern of falsified reports to government funders. The most viable path, he told her, was a plea agreement, negotiated in exchange for full cooperation on restitution accounting. She pleaded guilty to the lead charges on a Wednesday morning in a county courtroom, standing at the defense table in a gray suit she had bought specifically for the occasion, her hands folded in front of her on the table. She answered the judge's plea colloquy in a low, steady voice. "Yes," she said. She understood the charges. Yes, she understood the constitutional rights she was waiving. Yes, she was pleading guilty because she was in fact guilty. Yes, she had reviewed the plea agreement with her attorney. Yes, she was doing so voluntarily. The sentencing hearing was scheduled for a date several months later to allow for the preparation of a presentence report, the compilation of the restitution accounting, and the submission of victim impact statements from clients, staff, and donors of Cedar Hollow. The impact statements came in slowly, and then all at once. They came from former clients who had been told the emergency housing vouchers were delayed. They came from the shelter's current staff, some of whom had worked under Marlena for a decade and had defended her, publicly and privately, in the weeks before the truth emerged. They came from donors who had given every year for 15 years. They came from the shelter's founding executive director, now in her 70s, who wrote a 2-page letter that ended with a single sentence the local paper would later print in full. She was the person we trusted with the shelter. She stole from the women inside it. One statement from a former client, whose relocation voucher had been among the falsified reports, was read aloud in court by a survivor advocate at the family's request. The client, whose identity was protected in the record, had been told repeatedly across 3 months that her voucher was in processing, that the state was slow, that the paperwork was on Marlena's desk. She had eventually returned to the address she was fleeing because she had nowhere else to go. She survived. She wrote in her statement that she did not blame the shelter for what happened to her. She blamed one person. She wanted that person to hear her name, which the advocate then spoke aloud in the courtroom, and which Marlena, seated at the defense table, did not look up to acknowledge. Cedar Hollow Women's Refuge is still operating. The board restructured its financial controls in the months following the discovery. There are now dual signatories on the operating account, a required outside review of monthly bank statements by a board member other than the executive director, a formal fraud audit built into the annual cycle, and a whistleblower policy printed on the wall of every staff room. The shelter has replaced roughly 2/3 of the diverted funds through emergency fundraising and one large restricted gift from a national foundation that heard about the case in a sector newsletter. The remaining third has not been recovered. Ruth Ellery is still the treasurer. She has said, in the one interview she gave to a regional nonprofit journal, that she does not consider herself responsible for what happened. She considers herself responsible only for having asked to see the real statements. The question, she said, that anyone in her seat should have asked years earlier. And no one had. Marlena Voss's sentencing is scheduled. She faces a substantial prison term and full restitution of the diverted funds. The exact sentence has not yet been imposed, and it is not our habit here to predict what a judge will do. But the 2 stacks of paper, the summaries she wrote, and the statements the bank sent, are now in evidence. They sat on that conference table for one Friday morning, and they did what 9 years of quarterly board meetings had not. This case was quiet, but the case on your screen right now is louder, and the number is worse. Click it.